We mentioned some of the movers in the market, so let's talk a little bit more broadly about this Netflix move. Interesting, Mike, a huge pop that levitated the entire tech sector today and masked over the weakness in financials that we saw.
90% of all volume in the NASDAQ was to the upside today. That's a very lopsided positive number. Yeah, it did kind of remind people about the very long-term secular growth themes, obviously not applicable to every company, but Netflix, boy, the expectations were very high. The stock was up huge year to date going into it, and it just sort of shows you up 10% or close to that, exactly how good the quarter had to be to justify that. And it did. Now, it's not far above its old high in March, so you can't say that this is the start of anything big to the upside for Netflix. But I do think it's interesting, as saying last hour, the muscle memory of going back to tech, and people feel better about the market and volatility comes down. It's still in place. I just want to say the S&P 500 has kind of pulled itself back up into this neutral spot, right halfway from the lows to the highs of this year. We'll see if it can carry farther from there.
All right, we start to get some different kinds of companies reporting, Sarat. But in the meantime, the financials, we've been through the bulk of those, still waiting on Morgan Stanley's results, and the market reaction was largely not that great.
No, it wasn't. And what's interesting is if you take the Netflix versus you take the financials, is that they actually did pretty well in their numbers. But going forward, the expectations were just not there. They were just not met. And partially, I think, because of the interest rates that we're looking at. The 10-year.
That's what I was going to ask. So is it Goldman's fault today, or if the yield curve had steepened instead of flattening? And just so people are aware, the difference between the two-year moved so high today, it was over 2.4%. That's a 9-year, 8-year high. The difference between the 2-year and the 10-year was down to just 0.4 percentage points, and that's the smallest we've seen.
And what's interesting, the market is then looking to say the Fed's going to stay on at least 3 rate hikes. So what does that mean for banks? That means a flat to an inverted yield curve, which is actually very negative for them, but it's actually negative for the market.
It's usually a precursor to
a recession or a slowdown. And the other side of it is, well, if tech is doing so well, then the rotation that we saw today, part of it could have been just short covering. And the other part could have been like, hey, if we're going to get growth, we're going to go back to the sector that we liked before and forget what happened to Facebook, forget what happened to Amazon.
So
Here we go again.
The analogy that our guest made last hour, because we talk a lot about the flattening of the yield curve in 06 and 07, that we had a horrible crisis. We don't want to go through that again. But he said, look, 1994, you had that spread go down to almost nothing too. And then you had a rally, a tech-led rally, by the way, that continued for many more years.
By the way, 1994 was a stealth bear market. I mean, while that was going on,
that was when they had raised
the market
rates
struggled, and you were on the cusp of maybe, fighting inflation at the same time. You had a near miss, almost negative GDP quarter in 95. So it wasn't like all roses at the time.
And then just go back to 2016 when the 10-year went to 1.74, and we thought, here we go again. For 6 months, it was, unless you were in staples and utilities, nothing else worked. So we have to look at other indications, but today the market's kind of shooting first, asking questions later. But I do think there are a lot more indications as to why the 10-year is where it is, just because there's such a global demand for debt at this point, too.
And Bill, are you sanguine then? I know you feel generally optimistic about the U.S. economy, so do you shrug off what's happening in terms of yields and even the effect it's having on the banks?
Yeah, I think a bigger subject than the fundamentals of the banks is the psychology involved in the market. Those stocks did extremely well from election day in 2016 till the end of January. They were on fire. We own them. We know what it was like. It was great last year. It was the only way a value guy could survive in a market that has just been decidedly growth. You mentioned what did today look like? Mike Santoli will tell you, it looks just like 90% of the good days the last 3 years, right? The FANG guys were fanging. So the banks got too popular. If you look at Barron's this week in the big money poll, the banks were the most likely industry to be the best performer in the next 6 to 12 months. Well, it almost never happens that the one they think is going to be the best is the best. It's always the opposite.